Hello, everyone. Good morning, good afternoon, good evening. Very happy to see you for today's session, which is the second day of the Cannes Finance School. So really warm welcome to you all and very happy to see you in numbers. So if it's your first day of the finance school, I just briefly recap why you're here and what is it about, but hopefully you were there already yesterday. So this week we are proposing you a curriculum style journey that would build a progressive collective understanding of the issue of private finance for climate action and what it means for collective work on climate justice. So yesterday we did have a scene setter session, trying to understand better the politics shaping the private finance conversation and what it means for climate justice. Today, we're going to dive into the connection between the international financial architecture, its institution, and how they influence the climate debate. On Wednesday and on Friday, we're going to have deep dives on the different instruments that are at play when it comes to private finance promotion, and again, what it means for climate action across the board. So we're very happy to see you today, and we hope to see you in the coming sessions for the rest of the week. Also, be mindful that after this week, after this finance school week, we are going to organize an after school session where we're going to take it more into the strategy and advocacy discussion of how to translate all those concepts and this content we're going to hear from our speakers this week into proper advocacy campaigning. So stay tuned for that as well. So before diving into today's session, maybe I wanted to give a quick recap of what happened yesterday. Hopefully you were all around, but in case you missed it, I'll just give a quick glimpse of the discussion, but I really invite you to watch the recording in case you missed it, because it was really insightful and very useful as a scene setter. So one thing that was clearly said among the different panelists is the fact that public finance scarcity is not an economic reality, but a political choice. So Tasneem Essop, or executive director, highlighted, for example, that G7 countries spent about 3.9 trillion on militarization in the last 2 years, while in parallel cutting ODA spending in about over 50%. Zhou Wang also added that public resources are being mobilized at an extraordinary scale for fossil fuel subsidies, border regimes, and bailing out big finance. So definitely the question of scarcity is not a fact, but actually a political decision. The other thing that was shared is that the private finance paradigm launched in 2015, that's also being called the Wall Street Consensus, following the Washington Consensus, has not disappeared. Far from that. It has actually become the operating logic of climate and development finance. We also talked about investable development finance. So the billion to trillions narrative may be less visible, maybe nowadays, but the assumption remains that public resources should be used to de-risk private capital and make projects investable. And that rationale is present from the World Bank to the Finance for Development Conference, from Washington to Brussels. And the reasoning is that if de-risking hasn't been working so well so far, it's not because it's not a good idea, but it's because we haven't been organizing it well enough. So the narrative that we need more carrots to attract private sector more than sticks. But that's obviously, according to Daniela Gabor, creating fiscal and political time bombs for developing countries. So private finance also is not just there to fill the gap, but it's actually reshaping very actively climate policy around profitability. And that touches on the scale of climate finance, its governance, and its design. So Zhou Wang argued that capital does not necessarily follow price, but it actually follows expected profitability. So when we accept that private finance must plug the gap, we also accept its logic. Climate action only happens in that context if it can be made profitable, de-risked, and translated into revenue streams. Finally, I found that point very interesting as well, is the fact that the grammar, the vocabulary of climate finance has changed to welcome and attract private finance. For example, we are nowadays calling to all sources to be counted as climate finance. We're also calling upon a variety of actors to contribute to climate finance targets. But that's actually flattening historical responsibilities. So Jodiane explained us how climate politics shifted from clearly naming who has specific obligation to provide climate finance to a more neutral sounding nomination of everybody has a role to play, which is ongoing since 2009 with Copenhagen and the first climate finance discussion, but was really strongly reaffirmed under the latest climate finance goal. So this language blurs accountability, replaces obligation with voluntary pledges, and makes private contribution count towards private finance targets. So that was just some elements of the discussion yesterday, as I said, and I think it's a very good introduction to today's discussion, where we're going to dive much more into the international financial architecture institution and how climate finance is embedded in that broader system. So how those institutions, those rules, those power relations determine who can borrow, who can invest, who can spend, and who recovers. So the session will examine different things, including the role of key institutions, such as the Bretton Woods institution, so the IMF, the World Bank, the role of multilateral development banks, and how they shape climate and development pathways, particularly across the global south. It will also explore debt structures, fiscal constraints, credit ratings, conditionality, and financial governance as a whole, and how it influences countries' ability to, in the end, respond to the climate crisis and pursue sustainable development under their own terms. So hopefully you will get a clear understanding of how all those systems, this architecture in those institutions operate in practice and how they shape the debates that we are dealing with in our work around climate justice. So just final words, how to participate today and beyond. So first, very easy, you have a Q&A box below your screen. So feel free to use it as much as you want, whether it's to ask a question, share a reflection, share resources or something you wrote about the topic. We will monitor the Q&A box very carefully. And even if we don't answer directly to your point today, it will capture and feed into the toolkit that we'll talk about later on. The other way to engage and participate to the Can Finance Call is to answer a survey that we will circulating a bit later on this week, not only to give us the feedback of how you liked or not the school, but also to suggest future discussion that we could be having around the topic of private finance, but also future topic for future finance goals. So a lot of way to engage with us, and we hope that you will get on board on this important journey. So without further ado, I will now hand over to my colleagues, Mariana Pauli from Oxfam International and Habiba Fouad, who is an independent consultant, to help us facilitate the discussion today with our amazing speakers. Thanks, Mariana, and Habiba, over to you.
Great. Thank you so much, Rebecca, and good morning, good afternoon to you all. It's really a pleasure today to introduce this session to you with our two keynote speakers to do this deep dive on the role of international financial architecture and its institutions. So our first speaker, going straight, is Professor Céline Tang. She's a professor of international economic law at the University of Warwick. She is also the co-director of the Center for Law, Regulation and Governance of the Global Economy. Céline is a founding member of the IEL Collective, a community for scholars and practitioners interested in critical reflection of interactions between law and the global economy. And following Céline, we're also going to hear from Tim. He is Tim Hurston Burns. He is the policy liaison for the Global Economic Governance Initiative based at the Boston University Global Development Policy Center. He works he works his span across development finance, finance stability, trade, and investment, and he closely follows related policy process at the Bretton Woods institutions, the UN, and the G20. Team engages with different policymakers, think tanks, and civil society organizations like CAN and many others. So without further ado, it would be great to hear from Celine. You have approximately 10 minutes. Over to you. Thank you.
Hi, thank you all. And I think colleagues are going to share my slides for me. Thank you very much for inviting me here. So, yeah, I'm going to talk a little bit about the intersections between climate finance and the global financial system and the international and regulatory framework which supports this financial system, which we collectively know as the international financial architecture. Next slide, please. And I think it's really important that we think about this architecture, this legal regulatory framework, because when you see the shift from public to private finance, then the governance mechanisms, so the regulatory mechanisms, the legal agreements, the frameworks, they all change. And the oversight mechanisms for private finance may not necessarily be as robust to achieve these the climate goals that we want, and it's less accountable. So I think when we kind of look at the relationship between climate and sustainability finance and the international financial architecture, I think there are two things to take into account really. One is to look at the structural characteristics of the international financial architecture that has an impact on how climate finance is provided, how it's mobilized, how it's delivered, right? And then the second part of it is looking at how the international financial architecture is impacted by the types of financial instruments that are deployed for climate finance. So the terms, the operational structure, etc. And all these, I think, has an impact on not only on the effectiveness of those instruments to deliver it, but actually there might be unintended or intended, whatever way you want to look at it, impacts on other aspects of the economy, on the social political fabric of the countries that are in receipt of these climate finance instruments. So it's really important for us to unpack the relationship between climate finance instruments and the international financial architecture, not only just for climate, but also on countries' ability to meet other needs. Next slide, please. And so I wanted to kind of highlight two issues really when we look at the relationship between international financial architecture and climate finance. First of all, like I said earlier, the international financial architecture has structural features. It will have features within it that will hinder provision, mobilization, delivery of finance for climate action and sustainable development. So within, if you're operating within the system, then the type of finance, climate finance that is flowing is not going to be flowing effectively, or it will be hindering, or it has unintended or intended consequences, really detrimental ones. And then the second part of this relationship, I would say, is that the deployment of the wrong kind of finance without adequate fiscal policy space, without international financial architecture reform, are going to do various things. They're going to heighten existing economic financial vulnerabilities, because developing countries are very vulnerable. But then if you're exposing them to the international financial system without safeguards, without guardrails, it will just reinforce those vulnerabilities. And then it can undermine climate action, but more importantly, it can actually increase countries' susceptibility to financial and climate crisis and lead to things like the climate debt trap and also financial contagion, which is really problematic. So what we have at the moment is that we have an array of instruments that we're now calling climate finance, a retooling of financial instruments and policies that are actually embedded in the same financial system that underpins this kind of fossil fuel and extractive global economy that caused the climate crisis in the first place. So it's kind of like you're using the same tools trying to redress a problem that was caused by these tools in the first place. And I think that's where fundamentally why the instruments that we have are not going to work for the purposes that we want to see it working for. Next slide, please. So when you look at now, Rebecca talked about the speakers yesterday, talked about this private turn in financing for development and climate finance. So we see that, Wall Street consensus being operationalized through international financial institutions, through the policy debates and strategies of climate finance. And more, I think it's a given that the current policies and the strategies of climate finance really are promoting this kind of market-led green transition ultimately. And this whole movement to create through regulatory and financial incentives these kind of wide-ranging structural reforms within the host countries, developing countries, that can, ironically, constrain the fiscal and the policy in a regulatory space for countries to undertake energy transitions, climate action, whatever. So the actual policies and the instruments, the terms and conditions attached to these climate finance instruments actually have the opposite effect of constraining, right? Rather than enabling climate action. And more worryingly, they have wider implications for developing countries beyond just access to climate finance. And it can impact on the ability of countries to take action within the local space to protect the environment, to actually enact climate-friendly policies, and also impacts on their broader sustainable development goals and engagement with the broader international economy and international law. Next slide, please. So I just wanted to point out a few concerns that certainly in my research and my reading of climate finance that we need to think about when we look at the relationship between international financial architecture and climate finance. One, we know that I think most of us here who are interested in financing climate action and just energy transitions know that there's a real heavy reliance on debt instruments. And without a reform and without significant reform, actually, I would say, to the international financial architecture, these debt instruments will just increase developing country indebtedness. And we're just looking at, like the architecture basically for regulating finance hasn't changed, right? So you're just layering more complex instruments, you're layering more debt into a system which was already unable to cope because it doesn't have the mechanisms to deal with financial crisis or sovereign debt crisis in any orderly way. So you have a situation where countries are, faced with debt crisis without what we would call popularly as the insolvency process. So you don't have an orderly debt restructuring mechanism at the international level to deal with that, but you're, encouraging countries to take on more debt without that architecture. And that's really problematic, right? And that goes into the second point, which is that when we deploy these new innovative financial instruments, so we have all these like, thematic bonds, blue bonds, green bonds, sustainability linked bonds and loans, all these credit enhancement facilities that are all the rage, you don't have the regulatory safeguards. You don't have international financial architecture reform. And without these guardrails, without systemic reform to the legal and regulatory architecture, you just generate new transmission nodes for global financial instability. And that's really problematic. So you don't have adequate public regulation and oversight over cross-border financial flows, which means that private finance remains volatile, and it's less sustainable. So we see that in pandemics, we see that during crises. When there is a global crisis, investors take their money out, and there's no control, and it can be a very sudden shock. And this really has a problem because it's not sustainable and it's not stable for something as important as climate action. And then because of that, and I think Tim might go back into this in his presentation, there's a limited financial safety net. The international financial institutions, the global financial safety net is not there when countries are facing debt crisis, when they're facing financial crisis. So it heightens the exposure of developing countries. When we're moving away from public finance to private finance, we are increasing their vulnerability, not just to climate crisis, but also to financial crisis. And where we do have financial facilities and where we do have some facilities for support during financial crisis, it comes with policy conditionalities that can actually exacerbate the problems. And I think those of us who are familiar with international financial institutions, we know that the IMF has policies of austerity, of fiscal consolidation, that can lock down fiscal and policy space for countries. And paradoxically, constrain their ability to respond to crises, financial crisis, environmental crisis, crisis of sustainable development. And then some facilities, and this is where I kind of have this, I suppose I have a saying that I use regularly: the road to hell is paved with good intentions. And you have some facilities, like the Resilience and Sustainability Trust at the IMF, that can serve as green conditionality, mitigation through the back door, which can actually impose conditions on countries to adopt action that isn't compatible with multilateral commitments, places the responsibility on developing countries to mitigate. Whereas actually, the responsibility should rest on the developed countries. So, there's a lot of problems with these conditionalities. Next slide, please.
Celine, apologies. I think you have just another 1 minute. Thank you.
Okay, I'm going to go, if I could take 1 more minute in addition. One of the biggest problems with the international financial architecture is that it's inherently asymmetric in its governance, and developing countries have much less voice and representation in the international financial architecture compared to other forums of governance, right? And when you take that into consideration, and then when you move to private finance, it also means that more of the governance of the financial flows will go to the regulatory forums that developing countries have very little control over. Because if you look at if you're going to look at green bonds, for example, they're being governed by the International Capital Markets Association with their frameworks. Developing countries have very little input into the design of those green bond principles. The disclosure requirements for sustainable finance is determined by developed country jurisdictions, such as the EU, standard setting agencies, such as the IFB, and developing countries don't have voice and representation in the same way in those forums. And again, what's really important is that developing countries also don't have control over the financial regulatory institutions and frameworks for these big institutional investors in big financial jurisdictions. So we talk a lot about pension funds investing in climate action. But then pension funds are regulated and governed by their own home jurisdictions. And that can change. And if it changes, then the appetite, the ability of investors to invest, that's going to change. Developing countries have zero control over that because that's not within their domestic jurisdictions. So it's really, really problematic because, again, the pathway to climate finance and the access to it is dependent on many things outside their control. Next slide, please. And I'm running out of time, so I'm just going to go through this very quickly. The international financial architecture is also embedded within the broader systemic structural asymmetries of the international financial order, so trade and investment regimes. And the creation of these enabling environments where countries pledge commitments to undertake certain climate action in return for money through sustainability-linked bonds, for example, or green bonds, can actually create liabilities for them. It creates legitimate expectations. If they are not met for whatever reason by the countries later on, the investors will say, hey, come on, we came to your country, we bought these bonds, or we invested in your country because you made these commitments, and now you are reneging on it. Maybe they decided that a renewable project plant cannot take place in this particular region because of other environmental or social considerations, and they pull the plug on that. But the investor is saying, hey, come on, you know, we have expectations. And so, you know, they will be able to bring a claim in the investor state dispute settlement system in international investment law against the whole state. It is a real problem. And so we don't have a coherent international framework for dealing with this. And there's no multilateral framework for regulating global financial flows that is coherent with environmental agreements. And I think my last slide will be that in order for, last slide, we need a systems change to be able to enable climate action. So thank you very much. I've run out of time, but happy to take questions.
That's great. Thank you. Thank you so much, Celine. So now, without any further ado, I'd just like to invite Tim for another 10 minutes. Over to you. Thanks, Tim.
Great. Thanks a lot, Mariana, and thanks a lot to Rebecca and Ken and everyone for having me. So in the spirit of finance school, I'm going to mostly focus on understanding the role that these institutions play and then have some ideas on proposals and ways forward at the end, but also can get into that more in the discussion. So I'll mostly be focusing on the IMF and World Bank and trying to draw out the nuances of these approaches. But as an initial point, I want to just underline why they matter so much and the influence they have. And so one way of looking at that is looking at reported climate finance from developed countries. So what this chart is doing is looking at the total growth in climate finance reported by developed countries from 2013 to 2022 and breaking it down by source. And you see that green portion, over half of it, is multilateral development banks like the World Bank. So most of the growth in climate finance over the last decade, and with more up-to-date figures, I think that figure would be even larger. Most of the growth in finance is from multilateral development banks. Multilateral climate funds like the Green Climate Fund, they're barely even visible on this chart. So increasingly, it is the case when we are talking about the climate finance that is out there, we are talking about finance from multilateral development banks like the World Bank for good and ill. So going into the basics of these institutions quickly. So the World Bank and IMF have different mandates. So the World Bank is more about financing development projects. The IMF is more about protecting financial stability. So in very broad brush terms, if you're trying to build a bridge or a road, that is the World Bank. If a country is going bankrupt and facing a financial crisis, then they would go to the IMF. So they have different purposes, but fairly similar structures. And so in both institutions, they largely operate off government contributed capital bases and then extend loans based on that. So in contrast to aid budgets, for example, it is not a continuous stream of resources, but generally governments have put money in and the institutions use that to extend loans to members. And almost every country is a member of the IMF and the World Bank. And when countries put money into these institutions, that comes with governance power. So these are not one country, one vote institutions. They are not, democracy in the way that we would conceptualize it in a national sense of one person, one vote. Governance is much more like $1, one vote. When a country contributes $1 towards its capital base, they get corresponding voting power. And so as a result, global North countries have a majority of votes in these institutions. And one thing I want to emphasize is that, these are the largest international public financial institutions. There are other multilateral development banks beyond the World Bank, but it is the largest. The IMF is the biggest institution as part of the global financial safety net. And it is a bit ironic that they have ended up being promoters of private finance, and that reputation they have of often attaching policy conditionalities, of having policy advice that really focuses on countries prioritizing private finance. That is a fair perception of the institutions. And it is also the case that their original mandate was much more about being public financial institutions, that they were seen as institutions that could regulate the economy towards public objectives. And to take an example of that, the core development bank model, and there is lots that can be done, the ways that the World Bank has strayed from it, but the core development bank model is about taking the capital that governments put in. Then the World Bank, for example, it'll use that capital to issue bonds, get those bonds from private investors, on lend that money to countries for public purposes. So without going too deep into that model, in effect, the World Bank is lending its AAA top tier credit rating to countries that do not have that top tier credit rating. And it's taking money from private investors and allowing it to be used for public purposes. And that is a very different logic from the billions to trillions private finance agenda, which is about taking public money and using it to support private investment. So in a way, that's an inversion of the traditional purpose of these institutions. So, there is that public finance potential in the institutions, but the approach has ended up going in a fairly different direction. So to draw out these nuances further, this is just looking at debt payments from low and middle income countries. And so, and it's looking at their interest and principal payments by creditor source. And so that orange bar, the orange section of the bar, that is payments to multilateral creditors like the World Bank or the IMF. And so you see that's actually a minority of debt payments. Most debt payments from low and middle income countries are going to private creditors through bonds or commercial banks, those blue and purple bars. So most debt payments are going to private investors rather than public financial institutions like the World Bank and IMF. And again, that highlights the sort of liminal space they're in, that it is very much the case that loans from the IMF and World Bank are more expensive than grants. They are debt instruments. They create debt risk in a way that grants do not. And at the same time, it is also the case that loans from the World Bank and IMF are cheaper than what countries could get on the market from private investors. So they are in that liminal space. Now, looking specifically about how the institutions have addressed climate. Over the last few years, especially sort of post-2020, you saw the institutions starting to integrate climate change into their work. So part of this was just recognizing the relationship between climate change and their strategy and their mandates. So at the World Bank, there's the Climate Change Action Plan. At the IMF, there's a climate change strategy that recognized macro criticality. So basically saying that for macro financial stability, climate change is an important factor. Therefore, the IMF can address it. At the World Bank, the evolution roadmap you might have heard about over the last few years that changed edited the mission of the institution to be about a livable planet as well, and led to expanding finance in significant part with the idea that this needed to expand climate finance. And now there's a 45% a target for 45% of all the World Bank's finance to have climate co-benefits. At the World Bank, there are exclusions on most fossil fuels. People can point out fairly some of the gaps in that. And all MDBs, including the World Bank, made a pledge for 120 billion in climate finance by 2030. The World Bank instituted for some countries basically debt pauses in the aftermath of climate disasters. So you started to see this integration of climate in their work at the World Bank. At the IMF as well, there's the creation of the Resilience and Sustainability Trust that Celine mentioned, which is a longer-term lending instrument. The purpose is about creating resilience to potential climate risks. You could fairly ask questions about the conditionalities that have been attached to it. Increasingly in the IMF's surveillance, basically their policy advice, they have started to integrate climate change, but they have had a very particular approach to climate that is based around sort of market mechanisms that are more comfortable to the IMF's dominant ideology. So in particular, the IMF has focused on carbon pricing and removing fossil fuel subsidies, whereas a sort of broader anti-austerity investment-led approach is something that they have been slower to grasp. So all these policies were put into place. Now they are increasingly under attack. And so, yes, there are the desires for the IMF and World Bank to take a more comprehensive and justice-oriented approach to climate change. And it is also the case that the initial steps they took are under attack and at risk of being rolled back. So in looking at key priorities at the institutions, some I would flag include defending climate strategies and the integration of climate. It is just the case you can't talk about development, you can't talk about financial stability without talking about climate change. It is deeply integrated and is right for the institutions to recognize that. I also think it's important for the institutions to be leaning into the public finance strengths that they have. And so looking at that duality in these institutions, that they have huge public finance potential, but they have often used that to promote private interests. So there's a need to push for them to get back to their original mandates and lean into those strengths. It's also really important for finance to be aligned with national development and climate strategies, to not have contradictory policies coming from the institutions, but to use them to support the development and climate strategies that countries have, and also to take a more investment-led approach over an austerity approach. In preventing debt risks, in making forms of finance from these institutions more favorable to climate justice in the global south, is really important to be funding and expanding the concessional finance resources at these institutions. So when the institutions provide lower cost finance than they otherwise would, it does require funding through some source to drive down that price. And so at the World Bank, IDA, the International Development Association, that is the low income lending instrument, and that does require continuous funding. At the IMF, there are various instruments that are important and provide lower cost finance. So the CCRT, the Catastrophe Containment and Resilience Trust, so that is effectively a debt relief fund for countries in the aftermath of public health or natural disasters. So that's a really important instrument for providing debt relief to countries, but its funds are essentially depleted. So it needs funds for the CCRT to be able to work. In looking through potential sources, one I would flag is that the IMF actually is sitting on over $400 billion worth of gold. Gold is at extreme record prices based on idiosyncrasies from the global monetary system of the 50s and 60s. The IMF has a ton of gold it doesn't use, and they have sold limited portions of that before. They could do that again and raise really significant funding that could be used to support global South countries in their debt challenges. Another important instrument that maybe we can talk more about later are special drawing rights, which essentially help limit some of the inequalities in the international monetary system and give global South countries access to reserve assets that can be used somewhat like dollars. And so that is an asset that is created by the IMF. And while it would be challenging to get new allocation in the short term, it is something with huge potential. And there was this really important allocation of 650 billion SDRs in 2021. So it's a sort of thing that could be done again in the future. So I'll stop there for now, but looking forward to the discussion.
Fantastic. Thank you so much, team. And I'll hand over to Habiba now. Thanks.
Thank you, Mariana, and thank you, Tim and Celine, for this insightful breakdown of what the current global shift towards private climate finance means, and not only in terms of access to climate finance, but also its implications for national and international law, and the continuously changing position of the IMF and the World Bank when it comes to climate finance. So we have a lot of concepts to unpack here, and I want to dive a bit deeper into some of these main points that both of you brought up to make sure we're all on the same page. So I'll kick us off first with a question to Celine, and please continue sending Q&As, continue asking questions in the chat box, and we will circle back to those at the end if there is time. So Celine, you mentioned that climate finance instruments and policies are embedded in the same financial system that underpins the extractive global economy. that has caused the climate crisis in the first place. And you used the phrase like a financial contagion for this. So, could you elaborate on what the features of this extractive global economy that are being carried forward and causing this pattern to be repeated in climate finance are? You give some examples like debt and trade and investment rules, but can you give some country examples of how they impede on a just climate transition? And the second part of the question is you mentioned thematic bonds, sustainability bonds, guarantees um, that create this financial instability. So, could you explain why these instruments cause financial instability and give some examples of the safeguards and reforms and regulations that you proposed?
Hi. So I think we can collapse the two questions into one, really, because actually the second question provides the example for the first. So when we're talking about climate finance, there's a lot of these, conversations about how we're designing new instruments. Look, it's, green bonds.
Celine, sorry to interrupt. Your sound is a bit muffled.
Oh, sorry. So is that better?
Yes.
Yeah. So when we're talking about, like green bonds, blue bonds, they're billed as, sort of innovative because they ring fence resources for climate action. They ring fence resources for conservation of marine life, etc. But they're actually essentially, if you look at the structure of the debt contract, it's like a normal bond. It's a plain vanilla bond. There aren't any particular features that will make them more stable. Investors buy them for the purposes of investment for profit. So that's how, this is an example of how these instruments are not necessarily designed with any sort of additional features that will protect them. That will make them more stable. They will be more sustainable. They're still tradable on international capital markets. They, will still be rated by the same credit rating agencies. They are still part of the system that was used to extract the same level of profit. It's just that now we're extracting the profits from nature. And it's the same investors that are, also because we haven't redesigned, corporate law, we haven't designed, the fundamentals of how asset managers, are regulated. We literally are using the same frameworks just with a green wrapper on top of it and thinking that that's going to work because, people are going to see the words green and blue and they're going to buy this stuff and it's going to be, but there is some work that has been ongoing about inserting some sort of clauses into the contracts for these debts to allow for, let's say, if a country that holds a bond suffers a natural disaster, that you could suspend debt service if a trigger was met for a certain period of time. But that only affects that one contract. And countries have lots of different contracts for different forms of debt. And without an overarching regime that oversees all of it, like you get in a domestic insolvency regime, you're not going to be able to deal with it in a systemic way. You can't expect contractual contracts and clauses to be able to deal with a systemic debt problem. It's really fundamental. I think we kind of get hook-winged into a lot of these things and think that we can scale them up, which is the other rhetoric that we hear a lot. Let's scale them up. But you're not scaling up the regulatory framework. So the risk, and when we talk about de-risking, it's always de-risking the private investors. It's about providing the financial incentives, the regulatory incentives for the investors to be able to then, put their money or be incentivized to put their money in climate action or climate expenditure. But actually the risk, they're not taking any risk. It's not de-risking the community. It's not de-risking the project. So if the investors feel that they are not going to get that profit or the returns are going to go down, they will move their money out. And in many respects, and this relates to one of the questions in the chat about pension funds. Pension funds, sometimes it's not the pension funds that decide that they are going to divest from a certain, portfolio of investments. they divest because, they are under a duty by their regulator to divest when there is a risk that, of an impact onto their beneficiaries, which are the pension fund, the pensioners, right? The people holding who are putting their money into the pension. And so the regulator sets a threshold, and they can dump bonds. They will dump, like they are not, it's not sometimes it's not even the pension fund managers, it's the regulators. And the regulators are then setting those thresholds. So in many ways, the countries that are, being the recipients of this capital, they don't have any control over that legal architecture that governs these financial institutions. I'll stop there now.
Okay, thank you so much, Celine. That's very insightful and useful information. My next question is to Tim. You mentioned many pathways that the IMF and the World Bank can increase its concessional finance. You mentioned the Catastrophe Containment and Relief Fund, the Resilience and Sustainability Trust, and the potential of gold sales. Could you explain a bit more the difference between these different instruments and examples of how they can be utilized? And secondly, as you and Celine mentioned, that the international financial architecture is not only impacted by the instruments, but also by the structural characteristics of the system. So what are the ways within the IMF and World Bank or the MDBs in general that we can tackle the structural asymmetries in the international financial architecture? You mentioned the structure of $1, one vote, but could you expand on what gets funded and why, and therefore what gets left behind?
Yeah, thanks a lot for those questions. So looking at the different instruments in the IMF and World Bank that I highlighted. So IDA at the World Bank, that is the reduced cost lending instrument for low-income countries, and that requires regular replenishment for the World Bank to be able to provide finance at a lower rate than it would just based on its general model. At the IMF, the CCRT that I mentioned, so that's like the debt relief fund for countries that face shocks. But with these concessional instruments, to make it cheaper, you need to find some way to fund it. And so traditionally that has come through government contributions. I very much think global North governments have the capacity and responsibility to do that. And it is the case that is quite difficult right now to get them to contribute that money. And so I think it's really important to have organizations and movements like those representing CAN to be pushing those governments. And I think it can be easy to look at institutions like the World Bank and IMF and see them as a monolith, as a single institution. But there are a lot of different coalitions and factions within it. And governments are ultimately at the source of their resources and decision making. So pushing governments on these factors, I think, is really important. And it is also the case, especially on the IMF side, that there are ways to get funding for these sources that don't require contributions from governments. And that's something that's really appealing about gold sales, is that you could sell 10% of the IMF's gold, get $40 billion, and put that towards concessional trusts, and that would cost nothing from any government in the world. So there's real potential there. Similarly, with special drawing rights, that's something that that costs nothing to governments to create. When they created $650 billion worth of STRs in 2021, that didn't require any government contributing funds because of the unequal governance model of the IMF. Only a small portion of that went to lower income countries. But it is still the case that it's something that creates really significant and meaningful resources for global South countries at no cost to donor governments. Looking at your point about sort of the structural characteristics, yes, I think there are really important efforts to be had at the institutions to create at least more democratic governance. And it is the case now that, yes, they have this $1, one vote model, but even in relation to the state of today's economy, global South countries have less representation at the IMF and World Bank than they do just the share of the global economy today. Not even getting into population, the governance models have not kept up to date with the share of the global economy that now comes from the global south. So the institutions have been very resistant to change, and it's just this built-in contradiction that it is the countries that have power already that decide whether there are going to be changes to how that power is distributed in voting at the institutions. So there does need to be a push inside the institutions, but also by creating alternatives. When global south countries create alternative institutions, that shows that the World Bank and IMF can't always count on being the predominant institution, that there will be competition. And just the last point I would make in terms of breaking out of some of these structural asymmetries, you need more democratic governance at the Bretton Woods institutions, but you also just need to break the reliance on private finance that many developing countries have. That, as Professor Tan was saying, that's extremely pro-cyclical, it's very expensive, and at least public finance institutions provide an alternative to being reliant on these somewhat extractive financial sources. And then another important factor here, in addition to public financial institutions, is just tax. The more that countries are able to tax, the less they're reliant on debt mechanisms.
Thank you so much, Tim. I'm gonna pass on to Mariana to build on my questions further. Thank you.
Great, thank you so much, Habiba. And yeah, I just wanted to continue with our Q&A, going back to something that you both touched, but especially for you, Celine, you said really clearly in your presentation how much developing countries have less voice and representation in the international financial architecture compared to other international forums. So in terms of if we were to democratize economic decision making in terms of who's currently controlling all the decisions, how could we do it? And could you give us some examples of some more inclusive forums to drive financial decisions, especially on for climate finance?
Hi, I think thanks for this. I think, obviously a lot in order to have that compatibility, I think a lot of the decisions on how much climate finance, who to deliver, what forms it should be delivered, should come from the forum that governs, the climate regime, which is the UNCCC, right? But a lot of those conversations have been kind of outsourced to other forums, as we know, because that's, apparently where these decisions are being made. I just wanted to say something about private finance. I mean, ideologically, I'm not saying that we shouldn't have private finance in some ways to, invest and build capital, because I think in many countries that has worked, particularly in the East Asian countries. But it's all about regulation, and it's about the space for regulation. And I think that's the key. And what I see at the moment is that the financial architecture does not allow the space for countries to develop that regulation, because the mantra or the narrative is that countries have to liberalize regimes. They have to, and part of this is to create the enabling environment. So investors are not going to come. Finance is not going to come to a country if you regulate them within your domestic institution. So you might say, okay, you can come, but you need to, have a certain percentage of technology transfer, or you need to, abide by certain regulations, or you can park your money here, but you can't take it out for 5 years. All these are mechanisms that developing countries can use and can institute within their regulatory regimes, but they're seen as, something that will disincentivize, international capital. And that's not the case. It certainly isn't the case for a lot of the East Asian countries. I see Farhana's question in there about Malaysia. And there are, countries where there is a policy space to do that, and it is about regulation. I mean, I think and the suitability and the frameworks for proper regulation, and whether we have enabling environments, and I'm going to flip that term on its head. If we do have the enabling environment to be able to eliminate the risk of financial crisis, to eliminate the risk of climate crisis with these financial instruments in the way that they're deployed in developing countries. And I think, that's the key. It's not so much about how we democratize, like the financial institutions or places like that. It's about also, in many ways, it depends on a case by case situation, right? Wherever you are in different countries, it really depends on each country being able to kind of like, say, what space do we have? Do we want to go here? Do we want to open up? Do we want to change our laws to enable this? Because in the short term, we might get capital, but in the longer term, we might be subjected to so many other ongoing effects. And I think democratizing the governance structures at the international financial institutions is one thing. But I think for the developed countries, if your constituents in the developed countries, it's also something to look at, your financial regulatory systems, to look at the jurisdictions within that, and to make those kind of changes. I'm located in the UK, and as part of some of the things that some of my colleagues are doing is actually pushing the UK government to look at legislative reform to ensure that private creditors, for example, don't like hold out from collective restructurings of debt and claim from what, and refuse to participate in restructuring efforts in order to sue governments later on in the courts. And so we can move forward. I think there are different pathways to look at different forms of reform. And I don't think that one single point of how we can reform the architecture is going to work. I think it's going to have multiple pincer points, especially now where things are quite in flux because the geopolitical and economic circumstances are changing all the time.
Great, thank you. And then actually you touched on an important point that I wanted to come back to, Tim, in relation to debt. We know that most of the climate finance we had in the previous goal, the 100 billion, was in the form of loans, and also the new finance goal established in COP29, the 300 billion, does not clarify also what is the public finance component of that, which could actually lead us to more loans. So to some extent, it would be great to hear from you a bit more in terms of how how all this debt and especially thinking the role of credit rating agencies could worsen that situation, how debt and financial institutions are like shaping climate action due to the way they're operating.
Yeah, thanks a lot. I mean, it is important to underline what a central role credit rating agencies play here, and without getting into all of it, just so much of the cost of finance that countries face is dictated by credit rating agencies, which are extremely unregulated entities. So they're a shadow behind much of this. In looking at indebtedness and climate finance, I think there's the two sides of it. There's, before the debt crisis and after. And so there's the, provision of finance in a way that does not create debt vulnerabilities. And that's sort of the ex ante side. And there it's about these mechanisms like tax, like SDRs, like lower cost lending that can prevent countries from ending up in these debt crises. And that's much of what we've been talking about reforming the international financial architecture so that countries are not pushed into these cycles of debt. Then there's also what to do about the countries that have already reached debt vulnerabilities or reached unsustainable debt levels. And right now, due to the weaknesses in the debt resolution system, many countries are what we say defaulting on development and climate. Because the systems are working so poorly, they don't come forward and they just keep paying their creditors at all costs, even if that means missing development and climate goals. And so that really points to the need for systemic reform there. So I know we're running short on time, but yeah, I would just flag you need both preventing the buildup to these vulnerabilities through systemic reforms, but also addressing the existing debt stock. And one thing I would just really emphasize on both sides is that it does require action from governments. And there are these international institutions, but ultimately they are governed by governments. And so it's really important for people in their just different national contexts to be pushing the governments to play a better role there.
Thank you, Tim. Thank you so much, Celine, for answering all these questions so thoroughly. I'm going to pass on to Rebecca to wrap up.
Thanks a lot, Abiba. Thanks a lot, Mariana. And of course, thanks, Celine and team, for those great presentation and discussion and taking the time also to answering some of the questions in the Q&A. So really appreciate it. I think this session is fitting perfectly, following perfectly what we heard yesterday and setting again perfectly the scene for what we're going to discuss tomorrow. So thanks a lot for that. I'm now going to share a link in the chat for everyone to access the toolkit we've been preparing. So as I said earlier, it's going to be a living document. So we're going to place the recording as soon as it's available there. You already have Celine's and team slide deck, as well as some materials that were shared by the speakers. More will come your way. And we'll also place the key takeaways of today's session as soon as it's done so that you can access more content and also take time to digest the different concepts that were shared today. As we said yesterday, it's a learning journey that we're all collectively on. So please stay tuned and use as much as possible the different materials and resources. And yeah, thanks again to the speakers. Thanks again to all the participants who stayed for the full hour. You're again very numerous, so it's really nice to see you all today, and I hope to see you again tomorrow. Thanks a lot. Have a good rest of your day, evening. Bye-bye.
Thanks so much.
Thank you.